Rental properties are a great way to build wealth and generate cash flow, and using leverage for rental properties is a powerful way to maximize your ability to build your rental portfolio. Steve Bighaus joined me for this episode, which has been awarded the 2016 Best FlipNerd Show on financing your rental properties and building your rental portfolio. Let's go ahead and jump into the show right now. Hey everyone, it's Mike Hambright with FlipNerd.com. Thanks for joining us for this episode of the Expert Interview Show, where I interview leaders and entrepreneurs from across the real estate investing industry. So if you're new to the show, if you haven't listened before, if you're a first timer, hey, welcome here. We have hundreds of shows that you can access to learn from some of the most knowledgeable people in the real estate investing space. And if you already are a member of FlipNerd.com, welcome back. We're glad to have you here. And if you're not a member, please check out FlipNerd.com. You can get a free account in about 15 seconds now. We made it very easy. This is episode number 295 with Steve Bighaus. Steve has almost 25 years of experience in the mortgage industry. Specifically, he focuses on helping investors with financing or refinancing rental properties. And as a huge believer myself in building wealth and cash flow through rental properties, I'm really excited to have Steve with us here today because financing is key for rental properties. And we really hope to provide some clear steps to benefit everyone listening today, how you can either get started or ramp up your rental business. If you have been watching the show before, you'll know that recently we broke the show into two parts. Part one, we're going to get to know a little bit more about Steve. We're going to talk about different types of financing that are available. And then in part two, we're going to go into the taking action segment, and we're going to talk a lot more about how you can literally start taking steps to either getting financing or potentially even refinancing your properties. And Steve can help us with that. So Steve, how are you today, my friend?
I'm doing great. Doing really good, Mike, and appreciate you having me on the show.
Yeah, glad to see you. And so, what's interesting is it wasn't all that long ago that it seemingly became nearly impossible to get financing for real estate. It just basically, during the downturn, it got tough, and it's almost starting to get too easy in some instances before you're starting to see some crazy stuff happening from a finance perspective. But maybe you could, first, why don't you maybe take a minute and tell us a little bit more about you and your background, and then we can talk about kind of the history of financing and maybe where things are going. Okay.
Well, I'm currently partnered with Security National Mortgage. My team here at Security National is Team Bighaus. I have 6 people that work for me. Like you stated earlier, Nat, our primary focus, our primary focus in that is financing investment properties. So we did 396 loans for investors last year, which we were up about 22% from last year. So real happy with that. My side of the business, as far as what I do and the niche I've created in that, not real glamorous. Because, my average loan size is probably $80,000. And, and I'll do some of the smaller loans that some of the other lenders won't do. And I do that as a service to my client base because, let's face it, you shouldn't get penalized because you can buy something in Memphis or Ohio that maybe doesn't fit what a big national lender wants to do. But, it's an opportunity for you to buy a cash flow property and create that passive income. And so, kind of done that, and it's been a great niche. I get to, when I go speak at events, occasionally and I get lenders that say, you really do those? And I said, absolutely. It's business for me. It's great referral. It's a great referral network that we've developed.
Yeah. And you're saying that what the feedback you get or the questions you get from other lenders is they're questioning that the fact that you work with investors, you're saying, or?
Well, that, and I work with some of the smaller loan amounts. They would say it's not worth their time.
Yeah.
Which is unfortunate. Is really unfortunate.
Yeah, and from your perspective, and for those listening in, obviously, you're looking to build partnerships, right? You probably wouldn't do it if you knew every loan was going to be a one-off, but if you knew that I can help this person get, 5, 10, or more properties, then, I assume that's a big part of why you do it is because of basically the opportunity to be an ongoing provider for somebody, right?
Well, I do that, and it's great, and it's great to watch people succeed, and to get to those properties now where they're able to create that passive income, and they need to understand that it's just not short term, what they're looking at. They're looking at long-term investment, right. And to get them to that point, and that is very rewarding, and so I'm happy from that standpoint.
Yeah. Steve, well, let's talk about maybe at a high level. I know we're going to get into the details in the back half of the show, but just talk about different types of financing that are available. So because we have kind of veteran and new folks alike on the show, we may be a little academic for some of you that have experience, but I think a lot of people are often surprised that you can get government financing through Fannie type loans that they just wouldn't think would actually fund investment vehicles. But maybe can you just kind of lay out the most common financing types for rental owners?
Yeah. So you've got basically as a company we sell to both Fannie and Freddie, and so the conventional financing is probably 99% of our business, and that's where we're selling stuff through. So a lot of people think that it's really tough to get a loan. Well, when you're dealing with the investors, whereas maybe with the first-time home buyers you might struggle a little bit. Typically, the investors, and they've got the job, they've got some cash in the bank, they've got decent credit. Those people are not tough to do. I mean, they're just not. What becomes the issue with getting that financing is how knowledgeable that the person on my end is to be able to get that type of financing. That's where it really becomes the issue.
Yeah.
And typically, the investors can be a little bit more complex than, say, people that are buying primary residences. But both Fannie and Freddie, Fannie's always been pretty aggressive with the investors. They have been. Freddie Mac, they just came around in October of this year, made some changes, increased their number of finance properties to 6, did away with their landlord history experience requirement. Those are positive moves for the investor.
Yeah.
So when I hear people out there that said, it's really tough for investors to get loans, well, it really isn't. I mean, again, in that, what really determines in that is how tough it is going to be how good the person is on my side and the company. The company themselves want to be able to support the originators.
Yeah. So, and then outside of Fannie and Freddie, so Fannie and Freddie are typically, if you're getting started and you don't have any rental properties right now, or kind of under 10, if you will, that's probably the best place for most people to start, right?
Correct. And then a lot of people are recognizing right now. I mean, we're doing it with my wife. We're taking a retirement account, and we're going to buy some properties in our self-directed IRAs. And that's anytime that I look at my clients, that's one of the areas that I go to, and we always have that discussion. Even though I don't do that type of financing, I want to be able to be that point where I can give some, what do I want to say? Plant the seed. That's what I want to be able to do. And so, you've got the conventional financing, people can look at their IRAs, and then you've got some portfolio lenders that are starting to come out. I look at the portfolio side with some of those companies out there still a little cautiously because it's still relatively new and still getting their feet wet. And so I tell my clients, this is, because they talk to me about these things. I said, just think of your hamster on a spinning wheel, okay? So just think of how long you want to be on that wheel to get this done. My recommendation is we wait a little bit, see how some of these products go, and then we can jump on that. Or they can always move into the commercial realm. And so the commercial realm is where they'll bundle. They'll take the properties that they have, they'll form an S corp, they'll bundle everything. That's a little bit more complex, a little bit more costly. And I tell people, I says, let's right now and that, let's look at the the singles, because I think that's a better way to go. I mean, sure. I've done some stuff where we've bundled, where we've done the commercial loans, but it takes a while. It really does take a while to get them done.
Yeah, for folks that are listening out there, I'd say in my experience, lending, especially on the rental property side, is somewhere where you really want to think of your lender. Find somebody that is really kind of a partner, a member of your team, because you can maybe talk a little bit about what you do, Steve, but I know that when somebody can tell you, if it's not just transactional, like, hey, I need a house, come help me, and it's more like, here's what I'm trying to do over time, then you can provide some guidance there that you're just not otherwise going to get. Is that safe to say?
Absolutely correct in that. And where I want to be, and as I tell my clients, as I said, I want to be your resource. I'm not a 9-to-5 guy, and that's why I said if you need to contact me with after hours, you can pop me an email, send me a text, give me a phone call. Same thing on the weekends. I need to be part of their team, because that's the only way that they're going to get successful with investment, investing in lending. I tell them, I says, they got to have somebody that helps them provide inventory. They've got to have a good lender, maybe an attorney, an accountant. You've got to have a team. You can't be experts in all those areas.
Right.
The other thing is I tell the people, and that is that you can always find pricing a little bit cheaper than what I am. And the question I ask them, I says, that's fine. I said, so in other words, you can be a transactional customer or you can be a relationship.
Yeah.
And unfortunately, the people that are transactional are only going to be able to get you up to this point as far as property. They're not going to be able to help you after that.
Right.
And if giving you advice, they're not going to be able to give you any advice because they're just order takers.
Right. Yeah, and if you jump around that way, if you're transaction to transaction, you never get efficient in terms of doing the next loan because you're starting from scratch every single time. That underwriter may have different processes and stuff, and they don't remember. They can't say, well, remember last time we needed all this, or I remember all this from you about last time, so you don't need to provide it again, maybe in some instances. So there's a lot of value there to kind of building a longer-term relationship.
And I think not only the value on my side, I mean, all the information that we collect from our borrowers, we keep electronically. So if they come back to me 3-6 months down the line, I've got their application on file. We'll go over their information with them, make sure that employment hasn't changed. We'll address it, making sure they haven't moved, taken on any additional debt. So it's real easy to do. And then we also get, because I've got 2 underwriters and all they do is my stuff, is that when they come in, I'll look and see who the underwriter was on their last file, and I'll direct that file over to them because they're probably familiar with what they've done. So the process is a lot smoother, for the clientele. Definitely not as painful, absolutely by far, because again, you're not starting all over again.
Right, right. In my experience, Steve, maybe you can give some guidance on this. I'll tell you kind of my situation. When my wife and I started as real estate investors, we literally left our jobs, kind of cold turkey, dove in with 2 feet. I'm not saying that I recommend anybody do that, but one of the challenges we had is we got into this knowing we wanted to accumulate rental properties, and we built a nice portfolio now. The problem is when we went to get, then we basically couldn't qualify for Fannie and Freddie type loans because we were self-employed without 2 years tax returns. We were basically new entrepreneurs with no kind of safety net on a salary coming in or anything like that. Sure. And then the problem is by the time that we had that, 2 years later, we had well over 10 rental properties. And the interesting thing about the GSEs, the Fannie and Freddies of the world is this, it's one of those government things that you just kind of scratch your head and say, how does this make sense? Is the originally my thinking is, hey, I can get 10 properties financed through them, but you just basically can't own more than 10 rental properties. Even if I own them all free and clear, at the time at least, they wouldn't say, well, we don't care if you own 100, we'll finance the next 10. It was basically, you own more than 10, and therefore, we can't provide financing. Is that? Yeah. Am I saying that right?
So now on that, so properties that are owned free and clear don't count in that mix. We're only looking at finance properties.
Okay.
So 1 to 4 finance properties. I don't count commercial properties. So if you own an 8-plex, that's not going to be counted in the mix. The other misconception is people, and I got to laugh at this one, people have first and second mortgages on their properties, right? And some lenders will count those as 2 finance properties because they think it's the number of loans. Well, I don't care if you got 20 loans on a property; it's right. 1 finance property.
Okay.
So it has nothing to do with the number of loans. So the other thing to do too in that is that one of the things that I look at, and this comes into that whole scenario as far as being able to talk with the lender that knows what they're doing, is that, we'll get people that are husband and wife, domestic partners that want to buy properties. So the first thing I look at is, can I separate them? Can they qualify individually? Because I can literally double their buying power if they can do that.
Sure. So say that again. A husband and wife could buy typically up to how many properties then, if they're able to split? Why don't we say if you're able to split them up, and then talk about what that means, like splitting them up.
Basically, what I'm going to do is, when you qualify for an investment property, you only have to make enough money to cover your existing housing expense, whether it's rent or first mortgage payment, and any installment revolving debt that you have. I can use rental income from day one to offset the payment, so you're not incurring any additional debt. So if they both have jobs, and they're able to support that, I can split them up. Where they could buy, and so some lenders will come back and say that you've got to file separate tax returns and bank statements, a bunch of bunk. You don't. And that's just a lender overlay that they place. So the beauty about it is, here's what's really cool, is you get like asset statements, for example. Okay, a lot of husband and wives or domestic partners that they're going to have joint accounts.
Sure. And
so maybe they got $100,000 in this joint account. Well, let's say the husband's buying the first set of houses. Okay, so we need to make sure that he has access to all those funds. We just have to write a letter stating that he has 100% access to all those funds. Well, guess what? Then then he can do that. And then it's vice versa when the wife starts buying her properties. So there's things that you can do that definitely help the borrower. Unfortunately, a lot of the people out there that are doing some of the investment property financing, they're just not in tune to these tricks, or, well, I shouldn't say tricks, just they're tools that we can
nuances, yeah.
Yeah, we can utilize and make people, where they can really maximize their buying power. I mean, I've got, I can't tell you how many clients I have, husband and wife, that own double digits. I mean, 18, 19, 20 properties.
Yeah.
And they're set. And once they get to that, they go, God, we got 20 properties. We don't need to buy anymore.
Yeah, that's great. Okay, Steve, so let's jump into part 2, taking action. Let's talk a little bit more about how folks can actually get their financing and some things that they maybe need to think through. One of the things I want to say real fast, though, if you don't mind, is, the stuff that you just talked about some of the little nuances of the typical loan officer, or maybe every loan officer at kind of big bank USA, the banks that we drive past 10 of them to get to every day to wherever we're going, is they just don't get this stuff. You really need to have a partner that really understands it. And I can tell you from experience, we've banked with one of the largest national banks. We do kind of our operating funds there, but we've never used them for financing. But all the time they want to know, how can we get you into your investing business? And I know they can't do it, and usually over and over and over again I say, no, I don't want to go this route. I know that you can't do what we need, and let's not even waste our time. But it was about a year ago, somebody finally convinced me, let's just sit down and see if we can help. I don't know if we can, but let's sit down. And I said, okay, well, I have all these rental properties, and I have about 50% loan to value. I've got a lot of equity in there. We've got them well paid down. They cash flow really well, and kind of gave them everything. And ultimately they came back and said, no, we can't do that. This is it's too risky. is what they said. And I said, wait a minute. So you'll lend somebody that puts down 3.5% on a property, and they could lose their job tomorrow and therefore have no cash flow to cover it. And I'm telling you right now that these things cash flow, they could pay for themselves, for sure, tomorrow and for years to come. And it has 50% loan to value, and it's too risky. And the guy just looked at me like he didn't really even understand what I just said. So that kind of proves my point here of you really need to find somebody to partner with, like you, Steve, that really understands you as an investor and understands what it is that you're trying to accomplish.
You know what the irony about that, just what you were talking about. You're talking about lenders that don't want to do investment properties because they consider them too risky. That is such an erroneous statement. And because the numbers don't support what they're doing.
Right.
When you go back and we service our own loans, and that here at Security National, and then all you got to do is go back and look at servicing trends as far as nationwide, as far as what they do. Typically, you'll see the investor stuff run like I know, and I was just looking at ours. We're less than 0.5%. Delinquencies and foreclosures on with the investor side, okay. But when you get up into the FHAs, VA, and USDAs, they typically run double digits. They'll run 13 to 15%.
Wow.
Much higher. And, a term that you don't hear on the investor side is first payment default. And whereas you'll see that on some of the government loans. People get into the house, they buy a house, they don't even make their first payment, goes into foreclosure.
Yeah. Wow.
And, it's interesting to see. So what I typically find, and the example that goes in our industry is it says, if a person's got an investment property, a second home, and a primary, they'll keep their primary, they'll let go of the second home and the investment property, or that it'll just go down that path as far as progression goes. But in reality, let's face it. If majority investors, if you talk to majority investors out there today, and you say, okay, so you've got these 10 investment properties, and you're making your money in your primary. If you get in trouble, which one are you going to let go? And they go, my primary, I can rent.
Right.
I'm not going to give up my income and my hard-earned cash. And see, that's the difference. When you have your hard-earned cash into it, when you've got 20, 25, 30% into a property, and that property is making you money, why would you walk away from that?
Right. Yeah. Right. Steve, one thing I want to ask about with Fannie and Freddie, you're typically putting down 20%. Is that right?
Yeah, that's true too. And at single families, that's what you're doing. 20% down. With Fannie Mae, they have that dividing line of up, 1 to 4 finance properties, You can do 20% on a single family. With Freddie Mac coming into the picture right now, with them increasing that to 6, you can actually do your first 6 single families with 20% down, and then we could do the remaining with Fannie Mae. That's 7 through 10, the remaining 4 at 20% down.
Okay, and one of the things that we should mention is if folks are looking to, maybe we can get into some of the specifics of kind of refinancing here in just a second as well. But if you're looking to finance or even refinance, and you're able to use Fannie and Freddie loans, I mean, people are typically literally getting 30-year fixed rate loans on even on their rental properties. Is that right?
That's correct. Absolutely correct. I'd say majority of that's 98%. Everything's 30-year fixed. Occasionally, I get people that step out that want to do a 20-year or a 15-year, and that's fine. That's what they want to do. But the majority of it is 30 years because there is no prepayment penalty.
Right.
They always want to accelerate the payments if they can. And let's face it, if you're doing a $40,000 and $50,000 loan on a 30-year, that's a car payment nowadays.
Right.
I mean, they could take the extra money that they're doing and they could pay it off in that short of time. But they've got that option.
Sure. Yeah, when you start to get into portfolio loans or private loans or other things, you're typically never going to. I know even my banking relationships, they're 15-year amortizations and they're adjusting every 3 to 5 years,
right.
And the rate's adjusting. And so to be able to, I don't think there's a real estate investor on the planet that doesn't think that interest rates are going to go up at some point. Now, whether that's a year or 3 years from now, I don't know. But I know they're going up in the next 30 years. And so you can lock in. I don't know what your thoughts are on that, Steve, but you can lock in rates that are just historically low right now.
Boy, the rates are really good. And there's even talk about the Feds going back and undoing what they did in December and then bringing it back down where the Fed rate's 0. I mean, it's basically free money.
Yeah.
Is what they're doing. It's really hard to say. And it used to be, early on in my career, it was pretty easy to judge the cycle as far as interest rates. I mean, you could almost set your watch to them. But now the world, we're in such a world economy, and it's really complex. Things happen in China, they affect us as far as our rates. The gas prices are affecting them right now. Really tough to gauge as far as rates are going to go. And a lot of times people says, where are rates going to be at a year from now? I said, I don't know. My crystal ball broke a long time ago.
Yeah. Well, maybe Steve, I'd like to see if we could take give 2 different examples here for somebody that is maybe new or newer and maybe has a couple rentals or 0 even, and then somebody that wants to refinance, and just maybe kind of lay out some. I know that everybody has an individual plan, and there's specifics that you'd have to talk to an individual person about, but maybe just kind of give some high level guidance on. Let's start with somebody that has 0 or maybe even a few rental properties already, but they want to kind of accelerate that. What should they do from a lending perspective to kind of start moving forward?
I think that what's really important is start a dialogue with the lender. And somebody like myself and that's got a great background, with lending that can and has done a lot of this. And I think that's the first place to start. Let's talk about where you're at today. Where do you see yourself 3 to 5 years down the line? What are your goals? What do you want? What are you looking at doing? And I think that's the first place to start. Then once we get past that and kind of get a plan, then let's start the pre-approval process. Let's go back in and let's look at your financials. So typically what I'll do is I'll refer the client to my website, and so they can start the application process there. So they complete the application, we download it on our end. The system generates a list of documentation they need to provide us along with a secure link. And then once that comes in, we can pull a credit report. I can get back on the phone with the client and that kind of go over everything that they're at, where they're at. The dollar figure, a lot of times people say, how much am I approved for dollar-wise? Well, it's kind of a, irrelevant point, because what I'm really looking at is units, because I can utilize cash flow from day one to offset the payment.
Right.
Well, really what's going to drive how much they can buy is how much cash they have available.
Yeah.
So in other words, we have to look at cash as far as down payment. We need to look at cash for closing costs, and then they have to have reserves on top of that. And so that's really going to drive how many properties they can buy or the amount that they can buy. You just got somebody with a couple $100,000 in the bank, they can write their own ticket. So it's, even though we'll issue a pre-approval up to the conforming limit of 417, I really tell the clients, I says, units is what I'm really looking at, because we've got those dividing lines. And we want to make sure that we stay in, communication through the process to make sure that we maximize, like your 20% down payment on single families up to 6, then we move to the 25.
Yep.
And then do it that way there.
Okay. Okay. And one thing I want to kind of shamelessly plug in here is, I've been investing in really real estate for 8 years now. So I had no experience before that. And a lot of people know my story. We bought hundreds of houses since then. And I mentor and coach a team that buys, 1,000 plus houses a year now. We have a lot of volume. But one of the things that I've realized over time, I've been very geographically isolated historically. And really, as a part of starting the show and building relationships with people all over the country, it made me really understand the power of saying, hey, if your market gets tough to buy in, or if you live on the coast somewhere, like California or even on the East Coast, where you just can't find cash flowing rentals, instead of saying, well, I can't do that here, just say, I'm going to go somewhere else. Right. And there are tons of markets throughout the Midwest and the Southeast that offer opportunities, and we've built, and I know you work with a number of them too, some great relationships with turnkey operators. And so I think one of the things, if people want to grow rapidly, instead of putting all the hard work in yourself to try to find them in your own backyard, if you even can, if you live in California, it's pretty hard to find cash flowing rentals in most parts of the state, is to go to other markets and kind of accomplish your goal of growing there. And it really comes from working with a great turnkey operator. And just so happens that we at FlipNerd recently launched another site called passiverental.com, where we can kind of show you who some of the best operators in the country are and help understand your goals a little bit better, and then help you maybe get financing. We actually just to be clear here, we actually recommend and work with Steve in some instances there. And so anyway, if you're looking to grow your portfolio and you can't do it in your backyard, I'd encourage you to go check out passiverental.com.
I'll pick on you mentioned that. I'll pick on the Seattle market. I've got a client up here that'll buy quads, fourplexes. So he'll buy them distressed $300,000, and then he's got to put another $200 to $250 into rehab. So now he's into these $500, $550. Now they'll appraise for $750,000, $800,000, and he'll probably get, 12, 13, maybe $1,400 a door.
Yeah.
You can go to other markets in the United States, buy a quad totally rehab for $150, that'll generate $700 a door. So you do the math on those. It doesn't take you long to figure out where your money is better spent.
Yeah.
I mean, you can do it here in your backyard. And a lot of people say, well, I like them local. And I say, well, that's fine. Are you going to manage them? Because I'm sure not. You're going to pay a property manager anyway.
Right.
So it doesn't make any difference whether the property manager is 15 miles away or if it's 2,000 miles away. They're still going to serve the same purpose.
Yeah, absolutely. I can tell you from my specific experience, all my rentals are in the Dallas area here, and I'll go out of my way to not drive past a rental. In fact, I have not seen one of my rental properties. There's one that I saw that's not too far from my office. Unfortunately, my wife said, let's go drive past there. And I was like, no, I don't even want to know. We don't manage them ourselves. And what am I going to do if the grass is long or the paint's peeling or something? I don't even want that introduced into my head, because I know my property manager will escalate it if there's a serious issue to worry about. And sure enough, we're like, oh, they need to fix that garage door is kind of hanging crooked, and we just didn't need to go there. But I go out of my way to not drive past them, because I just don't want to know, and I pay somebody to figure that stuff out. And so it just kind of hit me after a while of like, well, if I don't even want to drive past them here, what does it matter where my rentals are? Right.
Absolutely correct. And and when I'm talking to my investors, when we're doing that initial consultation, I says, I can help you. You can find the property. You can find a great turnkey property. You can find somebody like me that's going to do the financing. You're building your team. But I said, you really need to have a great property manager.
Yeah.
Because that's going to make or break you.
Yeah. Yeah.
And so again, it's back to forming that whole team and being able to give those people advice. And let's face it, I've been doing this for 28 years. And then I own rental properties of my own. And then we're going to buy a few more. But I can tell you right now that I'm forming a team. I'm not an accountant, I'm not an attorney, and I don't try and do that type of thing.
Sure. Yeah. And I would say one other thing I would add is there's really a lot of benefit to being diversified and having stuff in more than one market as well. I mean, I'm in Dallas, where it seems like Dallas can do no wrong right now, but I'm looking to hold these rentals forever. And so 20 years from now, that could be a different story. And there's a lot to be said for being, kind of diverse in different markets as well. So
that's true too. And of course, people come back and say, well, if I buy a couple in Memphis and buy a couple in Georgia and that, is the financing going to still be the same? I said, it's all on a national level.
Right.
So nothing changes if you move from state to state.
Yeah. Yeah. Well, Steve, let's kind of go back and talk about the refinancing part now. So if folks have, let's say they, I'm trying to kind of profile people that might be listening in their scenario. Probably a common scenario is somebody that has a few rental properties and they've been hanging on to them for a while. So some people want to pay them off. They don't want to, essentially refinance them and extend their amortization way out because they're getting close to being paid off potentially. Some want to leverage them forever as far as they can. And with, you could have a pretty good argument for that with Fannie and Freddie type money where you can lock in a rate that's basically almost free money by the time you account for leverage and appreciation, any appreciation at all. So there's kind of both paths there. But let's just say somebody that has a few rental properties that is considering reinvesting them. Maybe talk about what some of the benefits are and then how they might go about that.
Yeah. So the first thing, that comes to mind, I get a lot of people that call me up and say, my rates are like 5.5%. I see the rates are lower than that. They're in the fours. Does it make sense to refinance? And so, when you take into account like loan amounts and different things, it's really not that big. And so a lot of times on the rate and term refinances, unless they've got a 6 or 7, 8% rate, really doesn't make a lot of sense. I want to do what's best for the client, not what's best for my pocketbook. Right. So a lot of times people will say, oh God, you're saving 0.75% or maybe a full percent. Well, on a $50,000 loan, it ain't that much. And by the time you go back in and pay all the closing costs, and if you see that you're saving $30 a month, but you spent $3,500 to get it, and you figure out where your rate of return is going to be on that, you're 4 or 5 years out, maybe even 6. Doesn't make any sense to me. So the rate in terms I walk through cautiously, the cash out though, where people want to leverage their money, where they want to pull some equity out, that I agree with, okay? Because that's a great way to take that money. If it's sitting there, you can take and turn that, and you can utilize that for down payment on that investment by all means.
Buy more properties, yeah.
With Fannie Mae, up to 4 finance properties. So you've got to be 4 finance properties or below to be able to pull cash out. And so, if you're above that, cash out just no longer an option for you. Now with Freddie Mac entering the picture up to 6, that's 2 more additional properties. That makes it a little bit viable.
Sure. Now, back to your thing about Fannie up to 4 loans. Is that 4 financed through Fannie? Or like if you have them with a traditional bank or community bank where the rate's adjusting every 3 to 5 years?
Doesn't make any addition. It doesn't make any distinction in that. They look at finance properties.
Yeah.
I don't care if mom and dad financed your property. I don't care if you got private money, if you got it with the bank. Okay. If it's under 4 family and you have it financed and you report it on your tax returns, it's going to be counted.
I see. Yeah, I'd say, to me, it seems like one of the bigger benefits of potentially refinancing, if you can get into a Fannie or Freddie type loan, is to lock in that rate, because a lot of any other loan that you have probably has a rate adjustment over time.
Correct. And then one thing that came out a few years back has been really beneficial. You'll get some of those clients that have like a home equity line or they've got cash, they pay cash for a property. Well, now what they want to do is they want to get their money back. That is as a spin-off of the cash out, so they call it delayed financing. And basically it says that if you pay cash for the property, you can receive up to your original purchase price back, roll in your closing costs, and I can utilize the appraised value to drive the loan to value. You've got a 6-month window from the date of purchase to get it done.
Okay.
So you've got that. So basically what people can do is they can recycle their money. So it's perfect when you get a person that's got like a home equity line, and let's say they've got $100,000. Well, they buy a property for 50. That property is worth, 70. When it's all said and done, they bought it at a pretty good price. Well, they can get their money back and they can recycle that and use it again to buy another property. So it's a great tool out there.
Sure. Yeah. Awesome, Steve. Well, we're kind of getting towards the end here. Any final words of wisdom? Is there anything that we haven't covered yet that you want to make sure you mention? And then I want you to share how folks can learn more about you and maybe get a hold of you if they're interested in talking some more about this as well.
I'm always happy to talk to people. And if they want to give me a call at the office, I'm assuming I can give my phone number, right?
Yeah, go ahead.
Yeah, my office number is area code 425-903-5647. You can send me an email at steve.bighaus@snmc.com. You spell the last name Bighaus. Always happy to talk to clients. Always happy. And so, sometimes when clients will come to me and the information that I give them or help them walk through, that's kind of like the pivot point for them.
Okay.
At the point in time, they were kind of on the fence. Internet is great. Ton of information out there on the internet. Now, whether or not it's all good, that's something else. Everybody's got an opinion out there. But what I won't do is I won't steer you wrong, okay? And I just want to make sure that I give you the right information so that you can make those financial decisions that are going to affect you not only today, but in the future also.
That's great. And Steve, did you say your website or where people should go for that?
Oh, yeah, it's Team Bighaus. Thank you. And again, the last name is Bighaus, so it's teambighaus.com.
Awesome. And just to throw one more site out there for those that might be interested in learning more about turnkey opportunities and buying rentals from some of the top operators in the country, you can check that out at passiverental.com. So we'll add links for all this stuff in the show notes here. Steve, I definitely appreciate your time with us today, and thanks for sharing all this information.
Always a pleasure to be on your show.
Thanks, Steve. And if you're listening, rentals is really a great way to build up income, and it's not all milk and honey, but it is a great way to build wealth for the long term. If you hope to, I mean, for me, that's quite frankly why we've done it. Is it's our retirement plan. Once you become self-employed, you have to do things like this to build up some wealth that you can rely on, and it'll eventually be a great thing for you. So thanks everybody for joining us today. And Steve, great to see you.
Good seeing you too, Mike.
Everybody have a wonderful day.